Cryptocurrency trading offers both high reward opportunities and significant risks, requiring a strategic approach to navigate volatile markets. Start by educating yourself on blockchain fundamentals through free resources like Binance Academy or CoinGecko's research portal before risking capital. Choose reputable exchanges. Coinbase and Kraken suit beginners with intuitive interfaces, while Binance and Bybit cater to advanced traders with leveraged products. Security is paramount. Enable two-factor authentication, use hardware wallets like Ledger for long-term holdings, and never share private keys. Day trading cryptocurrencies demands technical analysis skills. Master candlestick patterns, support, resistance levels, and indicators like RSI and MACD through demo accounts before live trading. Bitcoin and Ethereum dominate liquidity, but altcoins can yield higher returns, with greater risk, during market cycles. Futures trading amplifies gains, losses. Beginners should limit leverage to 5 by 10x maximum. Swing trading, holding for days, weeks, often outperforms day trading by avoiding emotional decisions and excessive fees. Passive income strategies include staking, locking coins like Solana or Cardano to earn 5–15% APY through network validation. Staking rewards vary based on tokenomics, research inflation rates and lockup periods. Yield farming in DeFi protocols, Aave, Uniswap, generates higher returns but carries smart contract risks. Only use audited platforms and never invest more than you can afford to lose. Tax compliance is often overlooked. Most jurisdictions treat crypto as taxable property. Track every trade, including DeFi transactions, with tools like Coinly or CoinTracker. Wash sale rules don't apply to crypto, allowing strategic tax loss harvesting. Market psychology separates profitable traders from the majority. FOMO, fear of missing out, leads to buying tops, while panic selling locks in losses. Develop a written trading plan outlining entry, exit strategies and risk management. Never risk more than 1–2% of capital per trade. Dollar cost averaging, DCA, into blue-chip cryptocurrencies smooths out volatility for long-term investors. Stay updated on macroeconomic trends. Crypto often correlates with Nasdaq movements and reacts to Fed interest rate decisions. Regulatory changes, like ETF approvals, create major price movements. Follow credible analysts on Twitter, X, but verify information before acting. The space is rife with scams and pump and dump schemes. Successful traders treat crypto as a marathon, not a sprint. Building consistent profitability takes years. Combine fundamental research, technical discipline, and emotional control. While some achieve life-changing gains, most sustainable returns come from patient accumulation and compounding during bear markets.